Hi guys, I am here today with our wealth specialist extraordinaire, Bongani, and we are going to be talking about unit trusts with international exposure. And I've got to be really honest with you, I'm not all that clued up on unit trusts. Like, I have an idea about them, I own a few in my account, but I'm especially interested to really unpack today those with international exposure and some of the top ones that are being invested in by our community. So welcome, Bongani. Let's do the things.
Thank you. Thank you. Let's do the things. Let's
Okay,
open up
so
that exposure.
let's start with some basics, okay? For those of us out there who are new to unit trusts, can you tell me what is a unit trust and how is it different from an ETF? Because they are quite similar, but in the same sentence, they're quite different.
Very true. Very true. I think, first and foremost, it's best to actually understand how an ETF operates versus how a unit trust operates. And I mean, an ETF is an index tracking instrument. We have specific indices, sorry, that the ETFs track. So I'm sure you've heard of the likes of the Satrix Top 40, there's a Signet Top 40. They have quite a lot of top 40s within the ETF space from multiple different companies that actually manage them. And basically, what the top 40 means is that it's just tracking the top 40 best performing shares in the JSE. So the Satrix Top 40 tracks the same index, which the Signia one does. They have multiple different ones. There's also an S&P 500 ETF, which tracks obviously the top 500 performing stocks in all of America's exchanges. So that's basically what an ETF does and how it operates. That's just simplifying it, but not oversimplifying it at the same time.
Got it.
Whereas a unit trust, basically very similar to an ETF. However, rather than tracking an index, what you'll find in a unit trust is that it follows a specific theme. So the themes are like income. And within the income theme, what they do is they not only track certain indices, they also invest across different income-bearing instruments, which are geared to like providing you income on a regular basis. So that's long-term interest-bearing, instruments such as government debentures, government bonds, and whatever the case may be. We also have a property theme, which the unit trusts go and follow local and offshore properties. Not just follow, but the locally listed property funds on the JSE as well as in the US stock exchange. They also invest in specific properties as well. So the theme goes on and on. We also have global equity, which you can obviously assume for yourself follows global equities. So I think those are the main, that's the main difference between the two. Other than that, they basically operate the same in the same way that, you put your money in and then the investment goes and runs its course accordingly.
And I've always got in my mind that a unit trust is a pooled investment. So it's a whole lot of people whose money goes into a pool, and then that pool is invested in all these different things, these different kind of themes within the unit trust, right?
Correct, 100%. That's exactly how it works. And then that's how the units are actually created. So the bigger your pool, the higher the price of the unit, meaning the better performing your fund is doing.
Okay. And also, ETFs are traded on the exchange, whereas unit trusts are not, right? What's that difference there?
So obviously, because ETFs, they are regulated in such a way that they have to be traded on because they're traded on the exchange, they're regulated in a specific manner. Whereas the unit trusts are also regulated, but not by the JSE, meaning they run on different times and different schedules. I mean, that also creates another difference with how the timing works of the unit trust and an ETF. So an ETF is priced throughout the entire day. From open to close, you'll always get a price at a specific minute, second, or whatever, or hour for this ETF. Whereas the unit trust only gets priced once a day. So because it's a bigger pool and the pools are invested across various different assets and allocated in various different ways. So it makes sense for them to pool the investments together at the end of the day and then submit whatever the price is for that closing day.
Okay. So in the last couple of weeks, we've been talking a lot about going global, having the world in your hands. And there's so many different ways to do that. Like you've mentioned a couple of ETFs that have also that also give you international exposure, like the S&P 500, the NASDAQ 100, there's those kind of things. You can obviously invest in, individual international stocks in the US, in the UK, in Europe, in Australia, using EasyEquities. But we also have unit trusts that both are partially exposed to international instruments, or fully. Some are completely international and some are partially international. Now, why would you choose one or the other? Would you favor one over the other? Does it depend on your personal strategy?
I think the simplest answer to that is, why not choose both? We're in such a space where you have the opportunity to spread your investment how you see fit. Because if I give you a specific unit trust which is completely offshore, and I'm giving you a minimum, then it makes the conversation a bit harder for you to be like, okay, now I have to choose either or. Whereas we've removed all these minimums on the EasyEquities platform, and you can go fully offshore and you can also go partially offshore. I think for myself, I like to see myself as a person who prefers to follow like the fundamentals of investing. And by saying that, I mean, I would take both options, and further diversify my investment portfolio. So you have that offshore, fully offshore exposure. You also have the partially local and partially offshore exposure. So, it's a win-win either way. But
yeah. That's totally my philosophy as well. I'm all about diversification, in terms of different industries, but also different currencies. And having a mix of the two is great. And I think what's nice is if you want some international or offshore exposure, some local, but you want to be a bit more heavily weighted in offshore exposure, you can do exactly that. You can get a unit trust that has a little bit of both, and then to sort of like give the weighting a little bit more to an offshore, you can get one that's just completely offshore, which is cool. So it's kind of like you're building your own little masterpiece of a portfolio as you like it, as you see fit.
100%.
So our most popular unit trust with global exposure is the Emperor Asset Management IP Global Momentum Equity Unit Trust. That is a mouthful. But that is our most popular unit trust on the platform. Can you tell us a little bit about this unit trust?
Yeah, no, definitely. I mean, this unit trust, firstly, it's managed by a very trusted, well-respected manager. And it's very, very diverse. I mean, the likes of Alphabet, which is previously Google,
nice,
is among the companies that are, invested across in this unit trust. T-Mobile, Shopify, just to name a few. And these are all international brands, which are obviously taking advantage of the market space they're in. What's really great about this fund is that it has managed to split its holdings across multiple sectors. So you have it invested in the likes of energy, healthcare, information technology, and the list keeps on going and going. So at the end of the day, you can kind of think of it almost as multiple different ETFs packed into one product, because all these indexes and all these industries and sectors are all, there's a certain percentage of your unit trust, of the pool, that has been split across into those different ways. So it's actually a really cool concept.
So well diversified unit trust that gives you exposure to lots of different industries with different themes, and has some really heavy hitters in it, like Alphabet and Shopify and some of those other shares that you mentioned. Do we have an idea of how this unit trust has performed?
So I mean, look, just looking back the past month for October, because the current month hasn't been released yet, the fund gave its investors a very healthy return of about 15%, which actually outperformed its benchmark. For those of you who don't know, each unit trust has a benchmark, which is basically like an index, or like, let's say, the standard, which the unit trust is aiming to either match or beat. And the benchmark, which was the S&P 500 for this month, was about 9%. So this fund actually almost doubled the return of this benchmark, which is very, very great.
Yeah, when it comes to my investments, I really like those overachievers. I have to say, that's 15% is awesome. That sounds really good. So. But it's not the only popular unit trust on our platform with international exposure. So I'm going to let you know about the rest of the top five, the big five. We've got the Allen Gray Orbis Global Equity Feeder Fund, the Ned Group Investments Global Equity Feeder Fund, the ABSA Global Core Equity Feeder Fund Class A, and the PSG Global Equity Feeder Fund E. So I have to know, what is a feeder fund? These are all feeder funds. What does that mean? Why is that different? Is there something special about it? What is it?
Yeah, basically, I mean, it's basically, if we're going to look at the pool analogy, the feeder fund is basically a pool, again, which all these funds are put into, which are then managed at the fund manager's discretion. So because these feeder funds and these unit trusts are actually offshore, it wouldn't make sense for them to use, Carly's investment of 10,000 and then go and convert it into dollars and then buy the shares and then do this and then do that, So
Okay.
basically, the feeder fund is what takes all of the funds together, moves them across into what they call a master fund, which they then manage all the offshore conversions and movements and buyments into all other shares. So instead of you as well having to go and convert the funds into physical dollars or whatever the case is, and then send it on to the fund manager, everything is done within the feeder fund. So essentially what that does is it's giving you access, because if you were to do this on an individual level, there would obviously be minimums involved, which would decrease the amount of access on people who have access to that market. So the feeder fund has very great benefits because of that, and because everything is done as a single batch transaction, So when they are making changes, it essentially allows for the costs to be spread and decreased as a whole for all the investors.
Okay. So if I'm understanding this correctly, all the people who are invested in the unit trust, all their funds are pooled, and things are constantly changing there. People are buying more, stuff like that. So the fund managers have this kind of fund that it sort of mimics what they say they're going to follow or what they're going to invest in, so that they don't have to take the investors' pooled funds and constantly be exchanging them into dollars, moving things in and out, which could be expensive for both them and the investor. So it's just a cheaper
100%.
way for them to manage it while giving you that currency exposure.
100%. Very correct.
Can't believe I got that all in. I'm impressed with myself. Okay, great.
Almost a fund manager.
Almost. I'm working my way there. Just watch the space. I'm going to be the first pink-haired fund manager to come to existence. I'm going to change the industry, disrupt it. So let's look at a little bit more data from our platform, from EasyEquities. What we're seeing is that in tax-free savings accounts, obviously that's an account where you can only invest in collective investment schemes like exchange traded funds or unit trusts. And what we're seeing in tax-free savings accounts is that unit trusts with international exposure are particularly popular in a tax-free savings account. Why would that be? Is there any reason they would be more popular in a tax-free savings account?
I think the main reason, again, is like as you've mentioned the name so many times, is the tax-free savings benefits. You're getting the opportunity to invest your funds offshore and receive a tax-free savings benefit on all the profits and all the interest that your investment's generating. I mean, it's a no-brainer that, you'd rather go through that route, because it's no secret that tax on international investments come in at a higher rate than local ones.
Okay.
So if you're that smart new age investor, you would know, let me take advantage of this tax-free savings benefit, move the funds offshore, get all that exposure, and you limit the amount of tax liability which comes to you at the end of the day.
Guys, I'm a tax-free savings geek. I absolutely love tax-free savings accounts. If you're someone who's not sure what they are, please go and look them up on our YouTube channel or on our blog or on our website. But essentially, tax-free savings accounts are a way for you to invest and not have to pay tax on the amount of profit you make, if you make any profit on your investments, on any dividends that you received, or any interest that you pay. So it's an awesome vehicle. Go and check it out. If you're not starting with tax-free savings, you are missing out. Don't get FOMO.
Definitely.
But now unit trusts are also available in different accounts. So obviously they're available in your regular ZAR account, your tax-free savings account. They're also available in your retirement annuity account. And this is another really tax efficient way to save for your future, to save for retirement. Why are there any kind of limits there in a retirement annuity? Because each of these accounts has a different structure that comes with different limitations and different benefits. So is there anything we need to be aware of when it comes to unit trusts in a retirement annuity?
Yeah, I mean, much like the tax-free savings, within the retirement fund space, it's mandatory for investments to be actively managed, and that feeds into your conversations about collective investment schemes. You cannot simply go and buy a specific share of a specific company or whatever within the retirement space, much like with the tax-free savings. And it's important for the fund manager to keep in line with the limits set out by Regulation 28. And essentially, Regulation 28 is just set out how these funds are supposed to be managed. There's specific limits within specific industries and whatever the case may be. So previously, the offshore limit for retirement funds was about 30% of your total investment. So that was the limit. So no matter how you spread your funds across, you make sure that only 30% of them were allowed to be invested offshore. However, the great news now is that it's actually been increased to about 45%.
That's
So that's
epic.
almost half. It is very good for retirement fund space, because again, you have that opportunity for international exposure, which could possibly outgrow whatever local exposure you'll be getting. And now you have almost half of your investment, which is allowed for you to be managed offshore as well. So yeah, those are the limits that to keep out for in the offshore limit sort of kind of space. But it's very great news.
And as an easy investor, you don't really even need to have to think about that, because all funds that you would invest in your RA already know that there's this 45% limitation. So any unit trusts that you invest in that do have international exposure are never going to breach that limitation. And so you don't even need to think about it. You can just know that investing in these different unit trusts means you're investing offshore, and to the maximum of 45% within that particular unit trust.
100%.
And so the most popular fund in our retirement annuity space is the Satrix Balanced Index Fund, which is actually in my RA. It's one of my
Nice.
one of my faves in my RA. So can you tell us a bit about why that might be? Why is this such a popular fund?
I think multiple reasons, and the first is that number one, Satrix is a very trusted brand amongst South Africans.
I think they just turned
Aside from
22 last week, actually, 22 years old.
Very, just as old enough to finish your varsity, I guess. But it's a very trusted brand. It's well respected. And to feed into, I think, the beginning of our conversation, we were speaking about themes. The specific theme for this fund is a balanced theme. And when people when they're giving their investment sort of approach toward their retirement savings, you don't have that much opportunity as you would like within the tax-free savings or within the ZAR, in such a sense that you can have 100% offshore. The next best thing is for you to look at the balanced funds, and the balanced funds are spread so wide, it is just unbelievable. You have invested in local equity, some in global equity, some in property, some in interest-bearing instruments, and et cetera, et cetera. And what Satrix has managed to do within the specific fund is to provide its investors with a very constant return. So you know what you're getting in, and you know what you're getting out. It's just it's, for lack of a better word, it's the best fund. Well, by numbers,
as voted for by our users. Well, according to the numbers.
I'd say also externally, outside of our platform, it's a very, very big, massively managed fund. So, yeah.
And I think that's when you're saving towards your retirement. I mean, I look at myself, I'm still relatively young. And I still, in my investing journey, am willing to take some risk because I've got time. I've got time on my side. I've got enough time to ride out the ups and downs of the market, because that's what markets do. They go up and down. But I have this long-term point of view. And so a portion of my portfolio, I do make high-risk investment decisions. And that means investing in things like crypto and equities. not all my portfolio, but a portion of it with the risk that I'm comfortable with. But when it comes to investing for retirement, I guess what you are looking for to a large extent is something that does deliver consistently. You don't want to be taken on this wild roller coaster with your retirement money. You know, you really want that to be solid and steady. And that's why all of these regulations are in place as well, is to protect us, is to make sure that we are taking a more, I don't want to say conservative approach, but a more responsible approach to our retirement savings. And so that's where the balance fund comes in. And if it's delivering more consistent returns, that's something that's a positive thing when saving towards your retirement.
Without a doubt. Yeah, well said. I think that's...
Thank you.
Yeah, well done. As a fund manager, yeah, I would invest in your fund.
I'm going to hold you to it. Well, that's all we're going to talk about for now on unit trusts, guys. But if you want to do some exploring, which I highly recommend you do, you're going to want to go check out wealth.easyequities.co.za, where you can go and look at all these different things, compare them, check out their performance, look what's inside them. And it gives you just a whole bank of information that's really, really useful in making those decisions. So thanks for joining us, and go and check out these amazing unit trusts with international exposure and be a global investor. You've got the world in your hands. Thanks so much for joining us, Bongani.
Thank you so much for having me.